All right, let's react to the problem with private markets, because this is an issue that will affect us as retail traders sooner rather than later.
Years of hiding behind mystique and illiquidity, private markets are being forced into the light. Private equity, private credit, and private real estate have been sold hard to investors on the premise that they offer higher returns with less risk. As fund managers push for these investments to become more accessible to retail investors, I think caution is warranted. I've always been skeptical of private assets, and I think my skepticism is being validated. 2026 has been a wake-up call for everyone who was convinced that private assets were special. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you why what we're seeing in private markets should not surprise anyone. Private markets are having an objectively bad time right now. Some private equity funds are having trouble selling their holdings, often resorting to selling private company shares to themselves. We'll get into that. Some private real estate funds can't sell their underlying real estate assets to meet investors' demands for liquidity and are having to gate or lock up their funds. And private credit funds, many of which are
These real estate problems are common in America and Europe as well. We see, for example, some of the REITs, some of the business development companies as well. The balance sheet might not be valued at where they actually put it, and a lot of companies have been punished regarding this as of late. We also saw a BlackRock-related private credit company, in this case, have to mark down the value on secured loans. So lots of trouble, and you can be sure that Wall Street will try to package this into some collateralized security where they take all of this and just put it together and then try to sell it to us. They always do this, when things get popular, they try defense stocks, bundle it together, sell it to us with higher fees. Just anything to get fees, as index funds are becoming more and more popular. Wall Street gotta make some money too.
Also gating redemptions are realizing that a lot of the loans they've made might have been a little on the risky side. I'm not really surprised to see any of this, but I think a lot of investors in private market funds will be. Again, fund managers have pushed private market investments relentlessly on the premise that they offer lower volatility and higher expected returns than what can be found in public markets. A compelling sales pitch for sure, but it doesn't smell right, and it never did. In this video, I'm going to discuss each of the major private asset classes: private equity, private credit, and private real estate. I'll review what the evidence says and what is happening in each asset class right now. But first, a little context. Private assets are simply assets like stocks, loans made to companies, infrastructure assets, which I'm not going to talk about, and real estate. And they're assets that have not been listed on a public exchange. This means you can't log into your brokerage account and trade private assets like you can trade stocks or REITs or whatever. It also means that the underlying company's disclosure requirements are not as strict. Since they don't trade on public exchanges, the prices of private assets are not being set throughout the day like what we see with publicly listed stocks, bonds, and REITs, making them the private assets appear less volatile. Appear is the key word there. For decades, private market investments were largely contained within the realm of institutional investors, entities like university endowments, pension funds, and not-for-profit reserves, entities with a lot of capital, extremely long time horizons, and professional staff. I would argue, with supporting evidence of course, that private markets are even questionable for those types of investors, but more recently private assets have been increasingly pushed onto retail investors, whether they're asking for them or not. In my day job as the CIO of a Canadian wealth management firm, I see these sales pitches all the time, and they're only increasing. The Ontario Securities Market Regulator is being pressured to authorize a new class of mutual funds that can hold higher risk private assets aimed at retail investors. Similar things are happening in the US, targeting the retirement accounts of American families. Even if you could convince me, and I don't think you can, but even if you could convince me that institutions should be investing in private assets, the case for retail investors is a lot harder to make. The underlying assets are illiquid, the fees are high, and the agreements governing fees and liquidity are complex. There is, however, a huge incentive.
And as retail investors, we have a lot of other private assets being pushed as well. For example, investments in gold, silver coins, You could even do high-end watches in this category. For example, if you decide to buy a Rolex, to flip it and sell it on. So there's a lot of these private assets, and it's very, very illiquid. As Ben Felix discussed, it's harder to sell. There's more rules governing. I'm doing some private equity myself, and in terms of the right to sell the shares in private equity, there's always rules around it. For example, a common one is that perhaps you have to offer it up to the other owners of the company first before you can find another buyer. And it's basically the equivalent of a block trade in the open market. You know, institutions doing a deal for a large number of shares. You have to find the buyer yourself and negotiate. It's not nowhere near as liquid as the open stock market in this case, and it can be quite hard to find a buyer at certain times. We've seen this for houses recently as well. Very good find from Ben Felix, and very important for us to keep in mind as retail investors when we see more of these funds of private assets being pushed.
To convince retail investors otherwise. Retail investors in aggregate have a lot of money, and the high fees charged by private market fund managers make them very attractive for the financial institutions selling them. This is especially true in a world where investors are increasingly adopting low-cost index funds for their public market investments, driving down profit margins for financial firms. Retail investors are also a huge source of potential liquidity for anyone currently invested in private markets who wants to get out. Liquidity has been a huge problem for private markets lately.
Basically, they want us to be bag holders. That's the translation to common speak.
But we'll get more into that later. This leads to the potential for adverse selection, where retail investors are showing up to the party a bit late, and they're the ones getting saddled with the illiquid stuff that nobody else wants to buy. While the debate about retail access to private markets continues, current investors in these funds have been forced to learn that their private market investments are, in fact, quite risky. We've seen private funds write down the value of their assets, and we've seen them tell investors they can't have their money back right now. We've even seen some of the biggest historical proponents of private market investing, Ivy League educational endowments, start to dial back their exposure and lower their expected returns for their private market allocations. Some large wealth management firms have been aggressively promoting their private market funds while criticizing the traditional 60-40 stock bond portfolio. They performed well for a while public markets were volatile, but now those same firms are facing serious problems. They've had to write down the value of some of their private funds by huge amounts, and they've had to tell investors that they can't access their own money right now because the underlying assets are too illiquid to sell.
Yeah, we saw, for example, Alexandria Real Estate write down the value of one of their mega campuses for life sciences, despite assuring investors that everything was dandy, nothing to worry about. That on top of a dividend cut. And you can see what the public market did to those shares if you just look up the ticker ARE.
Classic problem of private markets. This speaks to one of the inherent trade-offs with private assets. You do get less reported volatility. Awesome. Because the underlying assets are valued infrequently. Not so great. But you might be denied access to your money if the private fund does not want to be forced to sell its underlying illiquid assets when you need access to your money. Not great. In public markets, you can pretty easily sell at any time, but you're subject to market prices when you sell. It's an interesting question whether it's worse to live with volatility but always have access to your money, even if your investment has declined in value, or to be artificially shielded from volatility while potentially being denied the option to sell your investments at a loss. I don't have the universal answer, but I would generally prefer liquidity and knowing what my investments are actually worth. Private assets started gaining popularity following the 2008 financial crisis, likely, at least in part, in response to the traumatic levels of volatility in publicly listed assets over that period, and the need for investors to find ways to recover from the losses they sustained in that market decline. Private markets were sold as a less volatile place to invest while earning potentially higher returns. That alone, that combination of, hey, you can take less risk and earn higher returns, should be a major red flag, but people really want to believe that they are not subject to the economics of risk and expected return. They want to believe that they can find something special. Another
Yep, that's always a shortcut. That's how Wall Street gets you. The quickest way to the money rather than taking the tried and tested path.
big selling point for private assets has always been Yale's endowment. Yale had pioneered this strategy and had earned years of famously high returns in private markets with the legendary late David Swensen at the helm. Other investors have wanted to emulate that outcome ever since. Yale certainly did perform well, but recent analysis has suggested that their famed 30% annualized returns that a lot of people used as the backbone for the argument to go into private markets were not really returns. They were something called IRRs, which can be very...
Careful now, Ben Felix. I remember in business school they used to show this as a case to why private equity was so amazing. We wouldn't want to upset all the professors at universities now, would we?
misleading. My view has always been that net of fees and properly benchmarked, there's nothing special in private markets. I think this only gets more true in the realm of retail investors who generally pay even higher fees than their institutional counterparts. This point can be contentious, and I do acknowledge that there's a lot of room for nuance. There are some good private market funds, at least after the fact. We can find ones that did perform well, just like there are some good traditional actively managed mutual funds after the fact. Identifying them ahead of time is not so easy, but there are ones that have outperformed and there are ones that will outperform. But on balance, when you look at the data, I'm not convinced that the sales pitch matches the economic reality for private assets. Before we dive deeper, if you haven't already subscribed to this channel, please do. I make evidence-based videos on investing and financial decision-making, helping you make more informed financial decisions. Okay, let's look at each asset class individually. There's some wild stuff happening in each one. Private equity invests in private companies, attempts to increase their value, and then exit the investment at a profit. Private equity has multiple underlying strategies, with the two largest being buyouts and venture capital. Buyouts, the largest segment by assets, are where firms acquire a stake in a larger and more established private company, often using a lot of debt. Venture capital invests in early-stage high-growth companies with the expectation that a small percentage of those companies will be massively successful, while many will lose money. The private equity industry's value proposition for investors rests on two main pillars, in my view: diversification and market-beating returns. These are testable claims. I'm not going to recount all the research on this topic right now. I've done that in a past video, but there are two main takeaways you should know. First is that net of fee private equity returns can be largely replicated using public stocks selected to match the characteristics of private equity holdings. Second is that when you adjust private equity returns for the fact that private company shares are not valued every day, there is a dramatic reduction in any diversification benefit that may have been observed with the raw, smoothed returns. In other words, they're a lot more volatile than they appear. This is a concept that has been referred to as volatility laundering. Just because you don't see the price change every day like you do with public stocks doesn't mean the asset's value isn't fluctuating. A private equity fund may look stable on paper while the underlying...
I love that word, volatility laundering. Feel free to use that a bunch in the Discord. Absolutely fantastic terminology.
Underlying economic risks are exactly the same as, or even worse than, public market equivalents. There's also massive dispersion in private equity fund returns, meaning that there is a huge gap between the best and worst funds, increasing the penalty for choosing a bad fund. While private equity has delivered returns roughly in line with risk-matched public equity, the asset class has made private equity fund managers extremely wealthy. This is not an eat-the-rich type of comment. Private equity managers have been able to generate massive returns before fees. They're clearly skilled at their craft, and I have no doubt that they are brilliant people running these funds. The problem is that, as economic theory would predict, they are the ones, the managers are the ones that reap the benefits of their skill, not the investors in their funds. Well,
I remember when I was younger and I worked at a wealth management company, we would see some of these private equity funds where you would not be able to buy or sell except at certain time windows. I'm not gonna name the management company, but we could see that fees were a lot higher than for other funds. So clearly able to sell it, and as it just so happened, when that specific fund was recommended, it did not perform particularly well. So That fund eventually just got shut down or merged into some other fund, and then survivor bias just shows a bunch of funds that has outperformed, and you look into the prospect of these funds and think, hey, what an amazingly skilled manager, let me invest all of my money here. Well, as a matter of fact, it was the flip of the coin perhaps, and a lot of these survivors just show amazing results. You will never know, was it truly a very, very skilled manager, or was it just that this fund survived and the other ones that underperformed, got cancelled or merged into successful funds? Very, very difficult for us as retail investors, and we do not need more hardships, in the form of private equity being sold to us at higher fees.
For fee returns of private equity have been huge. The net of fee returns have been in line with public markets. This is explained by the exceptionally high fees charged by the managers. These include both management fees and performance fees and several other potential layers of fees that all add up to around 6%. The fee problem isn't the only issue plaguing private equity right now. The current state of private equity is that a lot of funds have been unable to sell a lot of their underlying holdings, not to meet investor redemption requests necessarily, but just to turn over the holdings in their portfolio at a normal pace. Usually private equity companies want to sell their underlying companies at a sort of 3 to 7 year cadence to return capital to fund investors and make new investments. The result has not been falling prices for these unsold companies, which is probably what we would see if they were publicly traded, but in the rise of more creative ways to get cash into the hands of investors. One prominent example is continuation funds. A continuation fund is a fund that buys portfolio assets from an existing private equity fund, often managed by the same manager, to give the fund liquidity. An increasingly common investor in continuation funds are called evergreen funds. Evergreen funds are semi-liquid vehicles that promise ease of use for investors and give fund managers flexible capital, which can be used to support continuation funds and make other investments. Evergreen funds often have lower barriers to entry than a traditional private equity fund, and they offer more liquidity, making them accessible to retail investors. While they have become an important source of secondary market capital, they raise a major concern. The fund manager often controls both sides of the deal. This makes the accuracy of the secondary market valuations a little bit murky and creates conditions for adverse selection. I think a reason that investors can more easily buy into these evergreen funds is that the manager has investments in an existing fund nearing maturity that they have not yet sold. This creates a structural need for exit liquidity to pay off the original investors. Private equity funds ideally want to exit their investments to an outside buyer after a few years. If they instead sell the assets to an evergreen fund or a continuation fund that they also manage, it may indicate that the manager struggled to find an external buyer, suggesting that the assets might not be something that you, the investor in the evergreen fund, actually want to buy. I think that there's a risk that you're buying a lemon that the broader market would not have touched at that price. This isn't necessarily always the case, but that's the problem. You don't know. They're not market-tested valuations in these transactions. Add on top of this risk that net of fees, as I mentioned earlier, the average private equity fund performs roughly in line with public market equivalents, and investors in these evergreen vehicles may be taking on significant complexity and valuation risk without being properly compensated for it. Another way that investors in private equity funds have gotten around the difficulties in selling their holdings is by selling them at pretty major discounts. Say you have invested in a private equity fund, but you need some cash. The fund isn't liquid, but you can find someone to buy your stakes at a deep discount. This comes with its own problem that's emerged, known as NAV squeezing. We've seen this issue surface recently with universities that hold private equity investments in their endowments, like Yale and Harvard. Universities, Yale in particular, as I mentioned earlier, were among the earliest adopters of private equity funds, as their long time horizons made them well suited to lock up capital in illiquid assets in exchange for what they hoped for, and maybe in some cases genuinely got, higher expected returns. Even if this strategy was historically effective in a slow market with high interest rates and private equity funds taking longer than usual to return capital, universities have been forced to sell their stakes sooner than planned to free up cash and fund their operations. This has been true for other investors too. To do this, universities like Harvard and Yale have been selling parts of their private equity portfolios to secondary buyers at discounts, averaging around 11%, at least in this data. This discount is a markdown from the position's net asset value, or NAV, which is what the fund manager is saying that the assets are worth. What gets crazy here, though, is that the secondary market buyers can put the purchase price on their own books and immediately mark it back up to the original NAV. So if Harvard sells a $100 million stake in a private equity fund at an 11% discount, as the average shows, the secondary market buyer can purchase that stake for $89 million, but then immediately mark it back up to $100 million because that's still the fund's initial net asset value. This is allowed in the accounting rules. So they paid less for it, and it's usually a private equity fund that is buying these fund stakes, like a fund of funds. On paper, the purchase has generated an immediate 11% return for the purchasing fund, even though nothing about the underlying value of the companies or fund stakes has changed. This process has become increasingly common, with secondary market sales increasing 45% to $162 billion last year, and it could be seen as a win-win for those involved in the transaction. Universities free up some capital, often still more than they paid for the initial investment in the fund, and the secondary buyer of the fund stakes reports a massive return for their fund. Recently, some fund managers have even adapted their fee structure to capitalize on this. Fund manager Hamilton Lane has updated their fee structure to...
Wow, of course they have. Zero surprises there. Also of note for us retail investors, when we listen in and we learn from this, we can also see in the public markets when companies trade at a discount to the balance sheet. That's just the market in real time, valuing this lower than what would be the net asset value that they have. So in some cases, it's do you believe management or not? And a very good point here, we don't get to see this in the private markets. We don't get day-to-day valuations, and doing the due diligence that we do on stocks here every day at Bullnova and that we do together in the Discord, how can you possibly do this at private equity as normal retail investors and see, are we getting a good deal buying into this private equity fund or not? Even if we look at the prospect and we see the 10 biggest assets that you have in that specific fund, how could we possibly be informed investors? There's a lot of information discrepancy in this case, and it's good that people are pointing it out.
Collect performance fees based on the unrealized gains rather than waiting until a company is actually sold, as would usually be the case. Hamilton Lane reportedly took in $58 million in incentive fees shortly after changing its fee structure, which they may not have seen for years, if ever, under the old fee rules. Again, if this whole thing smells a little bit fishy, I think you've got a good nose. Some people have speculated that this change in fee rules is because the fund manager themselves may suspect that these higher paper valuations may not last. And the mere presence of the discount when they buy the fund stakes lends some credence to this suspicion. It raises the question of whether the fund was ever worth the $100 million to begin with. When retail investors are sold and believe the idea that private equity funds can actually generate these returns for them, that becomes a problem. You may hold an investment showing strong official paper returns on your monthly statements, but when you actually need liquidity, you discover that you're either unable to access your funds or that you need to sell your fund stakes at a deep discount. Another current concern is the private equity industry's heavy exposure to software companies, where private equity has concentrated a huge portion of its deals over the past decade. The private equity playbook of borrowing a bunch of money to buy a successful SaaS business and then improving it a bit for an exit a few years later works when the economy is good and the demand for software is high, but it kind of falls apart when corporate spending is strained and something like AI threatens to disrupt the SaaS revenue model altogether. This exposure is now affecting other parts of the private market because who's private equity borrowing from to get leverage for these software buyouts? In many cases, private credit. Private credit consists of loans to private companies, kind of like bonds, except the loans are not publicly traded, and they're created by non-bank entities like private credit funds or business development companies, BDCs for short. We're going to talk more about them in a minute. These funds raise money from investors and make direct loans, often with...
Ah, nice. He mentioned the business development companies. It's kind of interesting to hear what he has to say for sure. They're often mentioned in the same breath as REITs when talking about certain alternative investment vehicles. And as for private credit, I've seen this being pushed in Sweden for a number of years now, and even retail investors being offered to put their own savings into these private companies and then getting 8% on paper for these loans, as a thank you for putting their capital there. And I'm not really sure that people are aware of the high risk and the riskier type of loans that these companies do to be able to justify these returns. Of course, you offer up your capital, you stand for the risk, they do the loan, package it, they take just a spread, a margin for doing this loan. There's a bit of a conflict of interest, like they get paid, but if something bad happens and the loan defaults, well, it's your capital at risk. So gonna be interesting to see what the Canadian market, in this case, that's Ben Felix's home market, is looking like in direct lending here.
Flexible terms and covenants to private companies. These loans, by their nature, by being loans to private companies, are risky. Like private equity, private credit funds will not have their assets marked to market daily. This allows them to appear low risk, even if the value of their underlying assets, of the underlying loans, would be fluctuating wildly in the public markets. And there's an interesting way where we can see that that's actually what's happening, and I'll talk about that in a sec. Similar to private equity, when the returns on private credit funds are properly evaluated against risk-appropriate benchmarks, I don't think there's anything special there. One important point is that similar to publicly traded high-yield bonds, private loans often share return characteristics with riskier stocks. While private credit has seen enormous growth, the asset class has recently started to see investors wanting their money back. But due to the illiquidity in the underlying loans, some private credit funds have had to gate redemptions. Think about this as an investor. You put your money in a private credit fund to try to get some nice juicy yield, which was marketed to you super hard in whatever app you're using or whatever financial advisor you were talking to. You start to feel a little bit uneasy for whatever reason about the underlying assets or about the economy, about your job. So you ask for your money back. The problem is that people usually start to feel uneasy about those things around the same time. So while everyone wants their money back, the private credit fund has to say no. Now, to be clear, this is not private credit funds being evil. This is a feature, not a bug, at least if you are the private credit fund. Private loans are typically long-term loans that are not expected to be or designed to be liquid. Investors in these funds should understand that going in, but I think that's easier said than done, especially in retail, as we have seen recently. In some cases, gated funds can be locked up for years. Publicly listed BDCs, on the other hand, offer a fascinating contrast to unlisted BDCs or private credit funds. Rather than gating, they feel the full force of the market's assessment of the value of their underlying loans. Take the FS KKR Capital Corporation as one example. It reported an increase in troubled loans and lower investment income, and the market responded swiftly. Again, this is publicly traded. The fund is down significantly for the 12 months ending February 27th. Another BDC, Midcap Financial Investment Corp, has similarly marked down some of its loans and been recognized by the public market for their honesty about their disclosures, again, with the price of that BDC dropping significantly. If nothing else, that should indicate how much risk private credit funds, unlisted private credit funds, where you don't get to see the valuations fluctuating in the public market, it should really indicate how much risk they're actually taking. Again, these are very similar things. One's publicly listed, one's not. When you have risky underlying assets, you're either going to get volatility, or if you say, I don't want to see the volatility, so I'm going to invest in a private fund, then you're going to get illiquidity when public markets get volatile. One of the problems with illiquidity is that you have to own assets that you know kind of stink. Once the fund manager says, no, you can't have your money back, that's usually at a time when the underlying are stressed or struggling, which is why they can't be sold. And you have to then continue to pay fees on those stinky assets to own them while you're not able to sell. The other crazy thing that's happening in private credit, where firms are getting increasingly creative for ways to come up with cash, with liquidity for the underlying funds, is they're turning to some pretty interesting shenanigans with insurance companies to meet their liquidity needs. So life insurance companies have traditionally kept their massive cash reserves in stable conservative investments, like whatever, stocks and bonds, things like that. Diversified portfolios. They're kind of the classic conservative institutional investor. Private equity firms are now buying insurance companies, moving significant portions of their portfolio into private credit for its higher yield. Insurance companies, so they take in insurance premiums. They have to be able to pay out the death benefit or the disability benefit or whatever when someone dies or becomes disabled. But in the interim, they can invest the excess premiums that they don't need to run the business, and they get to keep the difference between what they earn on their investments and what they pay out to policyholders. That's a simplification, but it's basically like that.
Excellent simplification. This is why I don't buy an annuity from my pension provider, for example. And the whole explanation of the difference in the spread, taking in those premiums on gross written, you write the premium, gross written premium, it comes into the insurance company. We love that on this channel. We see it in a number of the companies covered here, where the insurance side brings in a lot of premiums and generate some amazing returns for shareholders on the bottom line. Porch Group and hopefully United Health very soon as well. So not only life insurance, they have a lot of capital, and of course they don't just let it sit in the bank. They put the capital to use.
So the recent playbook that has emerged is that private equity buys an insurance company, and then instead of maintaining the typically conservative investment portfolio, they stuff its portfolio with private credit funds, often from lenders that are owned by the same private equity firm that now owns the insurer. Kind of crazy, and this process is creating a closed loop of risk with hopefully obvious potential repercussions if the private loans go sour. The issues rattling private equity and private credit are becoming increasingly clear to the market. Major publicly listed players in these asset classes, that is, publicly listed companies who sell and manage private equity and private credit funds, have seen their share prices get obliterated in recent history as the underlying risks in what they have been selling are increasingly pushed into the light. The last asset I'll cover is private real estate. Private real estate funds directly own real estate assets like apartment buildings, office towers, and shopping malls. They can have various strategies, but the general idea of owning real buildings inside of a private fund is consistent across this asset class. They're often not unlike a publicly traded REIT, except that the private funds don't trade on the stock market, similar to what we talked about with private equity and private credit. Also, like private equity and private credit, some private real estate funds in Canada have struggled with liquidity. This is not super surprising. The Canadian real estate market has experienced its worst real price decline going back to 1975. Public residential REITs have taken a beating, and private fund managers, understandably, don't want to be forced to sell assets that have declined in price. That's fine, and it's why their contracts with their investors allow them to gate their funds when too many people are asking for liquidity at the same time. In the midst of the liquidity crunch for many private Canadian real estate funds, some are considering going public as a source of liquidity. Being public means that investors can buy and sell their shares on the open market without the fund needing to sell its underlying assets, but it also exposes the value of the fund's units to market prices. While these funds consider going public, they've halted redemptions for current investors. I can't tell you what will happen with these IPOs, but I can tell you what happened in similar situations in the US. In November of last year, FS Specialty Lending Fund listed on the New York Stock Exchange at a net asset value of $18.67 a share. On the end of its first day on the market, it closed at $14. In December, BlueRock's Total Income Plus Real Estate Fund began trading on the New York Stock Exchange with a stated NAV of $24.36 a share. At close, the fund was trading at a market price of $14.70 a share, nearly a 40% drawdown from the beginning of the day. It's kind of funny. Funny is not the right word because there are real investors who are in difficult situations because of this. But these funds are sold as protection against stock market or public market volatility, but they often take huge hits once they themselves are exposed to genuine price discovery in the market. The risk was still there. They just weren't telling you about it or showing it to you. An important question then in private real estate is whether private real estate funds are adding anything special that cannot be found in a liquid public REIT. A 2018 paper finds that public REITs behave a lot like a portfolio of 60% small value stocks and 40% long-term high yield bonds, and that private REITs behave almost exactly the same way when a valuation lag is accounted for. In other words, the stock and bond factors that explain public REIT returns also fully explain private real estate returns. A 2019 paper similarly finds that when adjusted for the different leverage and sector composition of public and private real estate indices, there's no special return premium in private real estate. Again, this does not mean that there are no good private real estate funds. I'm sure they're out there. Private markets have been sold to investors as
And that's why I absolutely love REITs. Rather than buying a property myself, having to take care of everything from repairs to finding tenants to just general hassles of different admin tasks. REITs just allow me to own property. I can diversify it across geography, some in America, a lot in America, different states. You can find here in Ireland as well. IRES is the ticker. I don't like it that much though. But you can diversify, and you have a professional management firm that's doing all of the day-to-day business for you. You just sit back, relax, and collect those nice dividends. A lot nicer than rent, in my opinion. If you want the monthly dividends, well, you have ticker symbol O, for example. That's a very popular one in the REIT community. But most have quarterly dividends, and for example talked a bit about Medical Properties Trust here on the channel, paying a nice $1,000 every quarter in my case, and just a very nice public liquid alternative to private property in my opinion.
A way to increase their expected returns without increasing and maybe even decreasing the amount of risk they are taking relative to public markets. Recent red flags in private equity, credit, and real estate have shown that these assets are at least as risky as their public counterparts and may be hiding additional layers of risk due to high fees, illiquidity, and less scrutiny in how assets are valued. I'm glad that my firm did not jump headfirst into this space when it started getting pushed hard into retail channels, and I hope retail investors will approach these assets carefully as they continue to be promoted. If you want to know more about PWL's super boring investing philosophy, you can click here, or if you'd like to learn about the research on private equity, you can click here.
Alright, so thanks to Ben Felix here for informing us retail investors about some of the dangers of private equity. Now we know to keep an eye out for when these funds inevitably will begin to be marketed harder towards us. How do you mean marketed? Well, if you have a trading platform online, you're gonna see the emails get into your inbox about an amazing opportunity to invest in this new fund, and it's gonna be pushed at the front page, for example, when you search for certain investments, and it's just gonna be exit liquidity, perhaps, for fund managers who could not find a buyer for some of these illiquid assets. So big risk, but now we are more aware. That's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now. Bye bye.